proposition investing into ESG and investing into a thematic, right, as such. So for them, delivering uncorrelated returns, Helix is basically your very good alternative for you to take up. So we discussed. Now, there are a number of things out here that we need to talk about. First of all, is ecoeconomics suitable for everyone? The answer is no. It is suitable only for three categories of investors. One is if you're an individual and you are investing for your future, looking at your children, grandchildren, then suitable for you as an individual LP. If you're looking at it at a very short-term horizon, or if you're looking to, maybe make an instant buck, this is probably not right for you. The second category is we have family offices who have a long-term track record of investing in ESG. And ESG by nature has given them a suboptimal returns distribution. And it is fat-tailed distributions that we see with ESG-related portfolios. In order to tackle that, Helix is a very good option for that. You have the third category, institutions that have a long-term track record of ESG investing. Again, fat-tailed. In some cases, actually, you find that the returns are coming from a small number of big bets, right? So, a risky proposition, investing into ESG and investing into a thematic bet as such. So, for them, delivering uncorrelated returns, Helix is basically your very good alternative for you to take up. So we discussed three categories of investors. One, individuals who are looking at the future, not the immediate. The second category, family offices who have a long-term track record of ESG investing. Thirdly, institutions who have a long-term track record of ESG investing. Adding Helix to your mix basically becomes, it kind of lifts the return profile of your portfolio to a higher extent. That being said, Helix is not just a fund. It's a sustainable investing platform that we offer. On one side is the fund investment. Just said these three categories of investors, it's kind of ideal for them. You have the other side, the investment platform in itself, where you can learn about this thesis and you can test, build your own portfolio, also drive investment into that particular portfolio, either your own money or you can track capital based on that. Right? We help you essentially develop that strategy with all of the learning on the ecoeconomics thesis that you can get. Thirdly, if there are businesses that are raising capital, then by aligning to the ecoeconomics thesis, you are able to attract investment from a larger LP network using our own LP network, plus the larger LP network that we are able to tap into. And at the same time, it is often at a lower cost of capital than what you would have got in the market because of its ecoeconomic thesis. It is suitable for two types of businesses. One is if you are bringing in new climate or sustainable tech, then it's suitable for you. Or if you're a traditional business in any of the sectors, it is adopting climate or sustainable tech, then we are able to help raise capital or to merge, acquire a new business, etc. We are able to help with. Now, coming to where we are at the moment in our strategy, what we find is that there is one big sticky topic that we all need to talk about, which is the fact that uh, when we start off with maybe a thematic investment or quant or macro or fundamental value based investment, etc., we are starting off with a thesis and we are looking for evidence to support it. If we don't get the evidence to support it, we still go with that particular thesis. A very good example of this is if you basically look at people who follow, Warren Buffett's investing style, they go with the idea of investing into value stocks, and they invest into value stocks irrespective of how the market is performing. And this is something that we see, and they are often okay to accept suboptimal returns, saying that I invested in a Buffett style portfolio and it's fantastic. We also find many investors who say, I go small caps. Small caps are where the value is. This is where that we are able to get fantastic. In fact, the reality is a vast majority of small caps are undervalued. So you are going to get basically that value plus the market cap sort of a driver. But then small caps also have a higher risk profile because a number of them are not scrutinized the same way as mid caps and large caps. And we also find, I don't want to use this term, but we also find a lot of funny business goes on among smaller companies. But then on the other side, what we also have to see is if you look at the S&P 500, the Mag 7, basically the 7 tech stocks, they have grown massively in comparison to the 493 other stocks in the S&P 500. Now, are you missing out on this? Now, the other thing that which we also hear a lot is, I only look for high volume stocks, which have got very low spread, and I'm able to get a very good return out of it. Fantastic. But have you considered the fact that the evidence is showing the other side? Meaning, the volumes are often coming from institutional trades that are taking place in the third or fourth market. But then the spread is actually coming and hitting you during the market hours as part of the secondary market. This is a reality today because a lot of the block trades are taking place out of the market hours. So you are being hit with the spread, unfortunately. So given that, what if you had a method to look at the evidence and then think, am I proceeding in the right direction? An evidence-based approach. We use the evidence-based approach in other fields, most importantly in areas where we are trying to save lives, a field called as healthcare. Right? We use evidence-based things. We don't use a confirmation bias. Though our Instagram influencers will try to tell you, Instagram influencers, TikTok influencers will try to tell you this is the right thing to do and this is how you cure cancer or whatever. But we don't typically believe that when it comes to our health. Why should it be any different when it comes to investing? Shouldn't you be looking for evidence-based trades? Similarly, just like you're looking at evidence-based medicine, so shouldn't you be looking for the evidence? A lot of times what we also find is that the financial media is fantastic in explaining things after the fact. They will never tell you what is going on. So look at the FT, look at the look at all of the best financial media that you can think of. They have been very good at explaining things what happened yesterday. Have they been good in explaining what is going on now or what is going to come up in the future? The answer is no. Right. The best research tools that we find are often based on past data. Yes, past performance can give you a little bit of information, a lot of information about how future performance can be, but you cannot rely completely on that. What then happens is the fact that we are trying to overfit, meaning when we look at it, back test it, portfolio looks fantastic. When we try to trade it in the market, it doesn't perform as well. That is because we have not looked at the evidence. We have looked at a certain hypothesis. We confirmed it. We used our confirmation bias, and the data basically played to your tricks, essentially. And this is evident in the financial markets. It's evident in the media. It is very well evident in the number of trading and investing groups that you can get into. A lot of things that we will see are based on this one, and also the reinforcement bias that which also we have. Okay, this is how it is worked. Because this stock price was going up, I invested in this. I got this much. I could have stayed in the market and I could have made 25% returns in a single day. Unfortunately, that doesn't mean anything because you don't know why that stock price is going up. Was it because there was increased sales, or was it because there was a block trade? And then that trade is basically driving market momentum when the market's opened. But then what you then find is it fizzles out. It fizzles out very soon. So what if you had a method to understand this and signals that will tell you without emotion, devoid of any of this confusion, will tell you that's the trade that you can take. So that is what we use at Helix. And with that, we have been able to be uncorrelated to the market, high returns, significantly better than the S&P 500, broad markets, etc. This year, we are already about 65% up, by 67% up right now. So last year, we had 84%. This year, we are like 65% up. We should be closing the year at about 90% easily. So that being said, what is happening at the back is you have a situation where asset prices are inflated. Now, if I take the S&P 500 and if I dissect it, I will find maybe 20 undervalued stocks. A vast majority of them are overvalued. If I take the real estate markets, people might say it is a London problem. No, it's not a London problem. It's a global problem. You have the same issue in Mumbai. You have the same issue in New York. You have the same issue in San Francisco. You have the same issue in Dubai. Everywhere you have exactly the same problem because prices have gone up. Looking at the bond markets, you had a bull run for a very long time. So obviously overinflated. You have the same situation in every single market, in every single geography. And then the policy response for that, what you find is that, if it comes to, the housing market, our policy response is we have to build more. In the US, what we are saying is, with the oil market, drill, baby, drill, make more oil. The reality is there is a glut of oil. the OPEC has been dealing with a surplus. Do we really need more oil, or is it that somebody is driving that agenda, and they're basically getting more value out of that? Is it really a national security issue that we are trying to tackle? Is energy security only solved by oil or by anything else? That is the question to ask. Is renewables going to help you with energy security, or is the sun nationalized by some country and you can't use it? The wind has been nationalized by some country and you can't use it anymore. Is it only oil that will solve a national energy security issue? Question to ask here. And then what we also find is the US is trying to do basically dilute some of the regulations. The EU is also trying to do pretty much similar, cut the red tape, dilute the Green Deal. The UK is trying to do pretty much similar, reduce bureaucracy. So why did that rule come in the first place? If it is environmental regulation, or if it is consumer regulation that is stopping you from building this, why did that rule come in the first place? The question to ask is, if there was no reason for that rule, take it out. But if the reason was to protect people in that area, then by all means keep it. Don't go and take it away. Now, who is benefiting by taking it out? The big oil companies, the big housing companies who are able to build more houses, etc., build more, especially go and drill more oil. Is that really what you want? Now then the question is, if we basically look at it, we say, inflation is not that bad. Sorry, we don't measure asset inflation, boys. We don't measure that. We measure goods and services inflation. We are able to find consumer price index, consumer price inflation, etc., wholesale price inflation. It is goods and services only. We are not measuring asset inflation. And are you going to build your retirement and your future on the basis of goods and services? That is something that you consume, right? Versus the assets that you own. The assets that you own could be your house, some stock portfolio, some gold. A lot of us do buy gold. You could be holding on to maybe some bonds, mutual funds, etc., etc. And all of this becoming more expensive. I think that's the question to ask, because inflation does not tell you this. Interest rate information that you are getting is not going to tell you this. The evidence is right in front of you. That house on your street, which sold for 795,000, versus a house that was sold for about 600,000 a year ago, that is your indication that prices are becoming unaffordable. But what can you do about it? Cutting the red tape, is that the response to it? Absolutely not. Absolutely not. If you were to cut the red tape and make things more unsafe, guys, please remember what happened in the oil spills, what happened with the Grenfell disaster here in London. Think about the various housing related problems that we have had, various transportation related problems that we've had. Think if regulation is the problem, and if you take it away, it'll get solved by itself. What we are not talking about is asset inflation. What we are not talking about is wealth inequality. What we are not talking about really is the fact that underlying all of this is, when you say drill baby drill, whose capital are we using? So who is gaining out of that? If the UK is saying we have to build more houses, who is funding that? That's the question to ask, really. Now, when I look at ecoeconomics and when I look at essentially what is going on in the market, number one, what we find is it's basically a triangular relationship between financial, environmental, and social sustainability that we look for as part of ecoeconomics. Looking at S&P 500, taking out the Mag 7, not much of a growth, 4.5% growth this quarter. As we're looking at the corporate earnings, this is not the information that your average financial media is going to tell you, because they're going to look at the S&P 500 as a whole. If you take out the Mag 7, that's what you're getting. A lot of the boost has actually gone towards the tech sector, and that too very specifically the Mag 7. If you look at small caps, historically it's been very deep discounted, right? And we are still trading at historic lows. But then the question also to ask here is, what is equality, and what is the chance of an economic rebound that you're going to get? With the ecoeconomics thesis, there is a short-term cost. There is a higher investment that these companies have to make in order to be more sustainable in the longer term. And that's one of the reasons why I started off this discussion by saying, who is it for? It's not for somebody who is looking to take their money out in 1 year because they're going to retire. Not ideal for them. It's more for 5 years plus, right? It is for the future. The financial costs are there. The social demands are there. There are a number of short-term enablers, but there are a number of short-term events as well. So we are looking for innovative companies. So it's again a triangle. There's innovative, feasible, scalable, and investable companies that we're looking for. And that's I think the area where the aspirations gap also plays into this. Younger generations under 30, deeply concerned, aspire for a sustainable future. Their work patterns are quite different. There's a lot of frustration there. Unfortunately, policies are not driven towards them. There is a persistent economic inequality, and that is where some of the companies that are tackling these end up becoming very, very highly valuable. And essentially, what we're trying to do here is to use our graph neural network based system to, because we are using that, we are able to look at the broad market, entire universe of stocks, and understand where the value is without having to go into one financial statement at a time and then look into this. So it can give us the signals, and from those signals, we are able to take the value out and essentially present it to you. And the confirmation bias is a big killer. If you have been investing into ESG, you are prone to confirmation bias. If you have been investing in quant, macro, fundamental, value-driven investing, you're prone to confirmation bias. The only way you can come out of that confirmation bias is by using systems that will look at the evidence on the ground rather than, this is my hypothesis, look for data that supports it, right? So instead of that, look at the evidence on the ground and then make your decisions. So our systems basically superior in terms of being objective and unbiased, and it kind of gives you a signal that's what you invest into. And that's the reason why we are able to deliver quite high returns, and it identifies the hidden alpha, which you won't be able to find by looking at millions of financial data points. Holistic risk management at the back is what is needed, and what we find is managing drawdown is very, very important. The S&P 500 by nature, if you are using a S&P 500 based ETF or an index fund, S&P 500 itself has had a drawdown of 21% this year. So that is real. So being able to manage that drawdown is very, very crucial in order to deliver returns. I'll kind of stop here and open up for any questions. I'll stop the live stream here, but go ahead and post your questions on the chat. And you also know how to reach out to me either by message over here or on LinkedIn or the Substack message, WhatsApp message. If you're connected on WhatsApp, feel free to touch base. We'll chat a little bit more about what's happening this week. We'll chat a bit more about how our systems basically delivering value. All up, open for your comments, thoughts, questions. Thank you.